Market Risk Measurement and Management. Market Risk Measurement and Management in FRM Part 2 focuses on advanced frameworks used to identify, quantify, monitor, and control exposure to adverse market movements. The curriculum examines risks arising from changes in interest rates, equity prices, foreign exchange rates, commodity prices, and market volatility. Candidates study both parametric and non-parametric approaches to estimating value at risk and expected shortfall, emphasizing their practical applications and limitations within trading portfolios. The topic integrates statistical modeling, stress testing, scenario analysis, and model validation techniques to support effective market risk oversight. Students also explore the behavior of correlations, dependent structures, and volatility under stressed market conditions. By combining quantitative risk models with practical portfolio applications, the curriculum develops a comprehensive understanding of how financial institutions measure and manage market exposures in complex and rapidly evolving financial environments. Value at risk and expected shortfall models. A major component of the curriculum centers on value at risk and expected shortfall as standard measures of market risk exposure. Candidates learn how historical simulation, parametric estimation, and Monte Carlo techniques are used to calculate portfolio risk under different assumptions regarding return distributions and market behavior. The curriculum explains how expected shortfall improves upon VAR by measuring average losses beyond the VAR threshold and satisfying coherence properties. Students also evaluate model estimation error, quantile estimation, and confidence interval construction for risk measures. Particular emphasis is placed on understanding weaknesses of traditional VAR approaches during periods of market stress and extreme events. These concepts help risk managers estimate potential losses, determine capital requirements, support trading limits, and strengthen institutional preparedness against unexpected changes in financial market conditions. Backtesting, validation, and stress testing. The curriculum emphasizes model validation and backtesting because effective risk management depends on the reliability and accuracy of quantitative risk models. Candidates study exceedance analysis, failure rates, conditional coverage testing, and Basel backtesting frameworks used to evaluate value at risk model performance. The curriculum also introduces probability integral transform techniques and goodness of fit tests, such as Kolmogorov-Smirnov and Anderson-Darling methods for assessing forecasting distributions. Stress testing and scenario analysis are examined as complementary tools that evaluate portfolio resilience under severe but plausible market disruptions. Students analyze sensitivity analysis, model benchmarking, and conceptual soundness assessments performed during model validation processes. These practices help institutions identify weaknesses in assumptions, improve model calibration, and ensure that market risk frameworks remain robust under changing economic conditions, regulatory expectations, and periods of elevated market uncertainty. Correlation risk and dependence modeling. Market risk measurement and management also explores correlation risk because asset relationships often change significantly during stressed market conditions. Candidates study how correlations influence portfolio diversification, hedging effectiveness, and systemic risk across financial markets. The curriculum explains empirical properties of equity, bond, and default correlations while examining mean reversion, correlation volatility, and dependence structures. Copula functions, particularly Gaussian copulas, are introduced to model joint default behavior and multivariate risk relationships. Students also analyze correlation swaps and the impact of correlation assumptions on trading book capital requirements and derivative pricing. Understanding correlation dynamics is essential because diversification benefits may disappear during crises when asset movements become highly synchronized. These concepts help risk managers evaluate concentration risk, interconnected exposures, and the potential for systemic contagion across financial institutions and global markets. Fixed income models and interest rate risk. The curriculum includes advanced fixed income modeling techniques used to measure and hedge interest rate risk within portfolios and trading books. Candidates study regression hedging, principal component analysis, term structure models, and arbitrage pricing frameworks applied to fixed income securities and derivatives. The curriculum explains how recombining trees, risk-neutral pricing, and option-adjusted spread analysis are used to value bonds and interest rate options. Students examine the role of expectations, volatility, convexity effects, and yield curve dynamics in determining bond prices and hedging effectiveness. Key concepts include DV01 neutral hedging, multi-factor interest rate exposure, and the decomposition of yield curve movements into level, slope, and curvature changes. These quantitative tools support pricing, portfolio management, hedging strategies, and market risk control for fixed income products and interest-sensitive financial instruments. Strategic importance in financial risk management. The overall purpose of market risk measurement and management is to equip candidates with sophisticated analytical tools required to monitor and control trading and investment risk exposures across financial institutions. The curriculum demonstrates that effective market risk management depends not only on advanced quantitative techniques, but also on governance, model validation, regulatory compliance, and professional judgment. Candidates learn how inaccurate assumptions, correlation breakdowns, liquidity shocks, and extreme market events can undermine traditional risk models and create substantial financial losses. Stress testing, scenario analysis, and continuous model evaluation therefore become essential components of institutional resilience. By integrating risk estimation, dependence modeling, fixed income analysis, and model validation frameworks, the topic prepares candidates to support capital allocation, portfolio oversight, regulatory reporting, and strategic decision-making within increasingly interconnected and volatile global financial markets.